So sometime between now and the spring, and I would say between now and March or April, this is liable to really crack. But don't ever underestimate what the government, the Federal Reserve, will do with yields and rates and et cetera, and change that curve. So you've got to kind of watch it. But it's signaling very strongly that all of this game is about to halt potentially quite abruptly.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. If you're familiar with the concept of the fourth turning, it's hard to deny that we're in one now. A fourth turning is a societal cycle in where the power structure and institutions that long existed beforehand are disrupted and dismantled and eventually replaced by a new order. Daily now, we're seeing an accelerated dismantling of the status quo. So whether you deem that good or bad, it raises an existential question for investors. How do we navigate a fourth turning with our wealth intact? To discuss, we're fortunate to speak today with market analyst Gordon Long of MATASII, Macro Analytics and Technical Analysis Strategic Investment Insight. Gordon, thanks so much for joining us today.
Well, thank you for having me, Adam. I always enjoy our discussions.
Oh gosh, me as well, Gordon. You look great. Happy New Year. Lots and lots to talk about. We're kind of mashing together two things the audience has been really looking forward to. Folks have been asking me, hey, when's Gordon coming back on? But also a lot of folks have been saying, hey, get somebody to come on to talk about the fourth turning. Folks, I will be getting Neil Howe back on the program at some point. He's the demographer who came up with the term the fourth turning. But in the interim here, we're going to talk about how the fourth turning relates to investing. And can't think of a better person to talk about that with than Gordon. So Gordon, you've been kind enough to prepare some slides for us on this topic, which we'll get to in just a second. Before we get to the slides, though, if I can just kick this discussion off with my normal starting question, what's your current assessment of the global economy and financial markets?
Big question, and we're going to get into a fair bit of that in the slides. But I think we have I've been pretty negative here quite a few years now. And it's because I see a debt crisis coming. I see the direction that we've been going is fundamentally flawed, and not just the United States, globally. Having said that, in the last 3 or 4 months, I've become much more optimistic than I've been in a long time of what I see ahead, and at least pointing ourselves in the right direction. The headwinds and the challenges that are in front of us are serious. But at least I think we're beginning to come to grips with, and a broad base. There's always been people that have been talking about it, but I think more and more people are realizing the seriousness of our problems economically, financially. It gets into all the elements of fourth turning through culture and social. But at least we're beginning to be aware of them, and with that can come change. So I am quite optimistic. Now, that doesn't mean that we don't have some real problems over the next 6 to 18 months. And I'll point some of those out as we go.
Okay.
Which is opportunity, by the way.
Right. Well, so let me ask this then. So your concerns, that you're talking about were, macro concerns, things like a debt crisis, stuff like that. On the market side of things, when you talk about, a rough sort of 6 to 18 months from now, are you talking economically, or are you talking financial market wise in terms of asset prices, or are you talking both?
I'm talking both. Because, for example, right now, and markets are, I don't spend a lot of time right now, for example, in the equity markets. There is money to be made in precious metals, for example, but commodities, currencies, more so in the bond market, in the credit market. So there's a lot of markets, and they're all working with kind of different cycles, and though they're obviously tied together. So we could talk about each of the markets, but right now the equity market looks like it could be a pretty good year for us, and we think there's still a bit of a run to go here. With high risk, that is. We still a big strong believer in the whole gold and silver complex. We think it's only in early stages there. Of course, We've been there for quite some time. But the dollar itself being so strong is we've been a real hawk on financials, financial sector. Look at the banks, the European banks, as bad as they are, they're outperforming or performing equal to the Mag 7 right now because the euro's falling with a strong dollar. So, a strong dollar is presenting a lot of good opportunities. It's helping in the credit markets currently, but that can change abruptly with a weaker dollar. And as you probably and well know, and I'm sure your guests have talked about, the correlation right now between yields and the bond market, and specifically yields in a dollar, is just I've never seen it mirror each other so closely. And so with when the dollar weakens, and it will weaken, the euro will reverse. So when the dollar weakens, I expect to see commodities finally break out of the consolidation that they lifted pretty heavily here about 18 months ago, but they've been in a consolidation phase, and I expect them to lift. I didn't mean to wander on there, but it really is about each of these markets, whether you're talking markets or economics. I've
Okay.
never
All right.
seen the macro more important in making macroeconomics more important in making decisions as I've seen and I'm seeing right now.
Okay, wow. And you've had a long and successful investing career, so that's quite a big statement, Gordon. All right, well, look, why don't we start walking through your charts, and then, we'll get to the specific opportunities you see. We'll talk more about the specific opportunities you see in those individual asset classes. Because this is interesting. It sounds like you say, hey, there's going to be some volatility, there's going to be some changes like the strong dollar shifting to weak dollar, et cetera. But that is going to spell opportunity, if I'm reading you right, for investors that intuit that in advance and position wisely.
Exactly. There's always change, but these cusps now are between markets, commodities, dollar, currency, etc. And as they shift, and they will be shifting in this state of turmoil that we're in with the fourth turning as an element of it, there's going to present opportunities. But if you're just, for example, many people talk to me, they just are an equity person and they're just into stocks. Um, I caution you that could be a really tough time for you because we're beginning, and we've talked about this previously, that we're in the beginnings of what I call a beta debt drought, a decade long drought. And all the major corporations, banks are talking about the earnings are superb. We're at high ends, but typically after that, total returns are weaker for a protracted period, numbers of years. This is a classic cycle, and they're all starting to take their future years down. So, equities can't continue to perform as well as they've been. That's what I caution you there.
Okay, well, look, that sentiment of it likely being we may have a period of lower returns ahead of us in equities. It's been echoed by a lot of people on this channel recently, but it's also being echoed now really kind of by mainstream Wall Street in a lot of places. Very visibly, Goldman, this was a couple months ago now, but they came out with a sort of a warning saying that, hey, we think that returns over the next decade could average only like 3% in the equity markets, just given how rich prices have come. And for a bank like Goldman that their business is to sell people, these equities. For them to say something like that, they're saying
They're rounding up.
Yeah, and they're rounding up. Yeah, good point. All right, well, look, let's roll up our sleeves and get into it.
But they are right. This is the beginnings of a decade-long beta drought that we will see. That doesn't mean you can't make money in equities, but it's not going to be as easy as it's been for the last 4 years. That's for sure.
Okay, and that's a really important point. We've had I think a growing number of experts come on this channel basically saying, hey, it's been easy for investors for a good long time, and that's why passive investing has come so into vogue, right? That in fact and understandably so, it's kind of hard for the active investor to beat just these passive indexes when the tide just kept rising every year, right?
Well, fund managers themselves are having troubles beating the indexes, and so they've got the fund managers. It's in mass, and it's because of the ETFs. But it's going to change. It's going to become a stock pickers market as we go in, and sector picking more than we've had to do in the last the 5 years. You could buy anything, and so what's happened is it's forced all these money managers. I call it FOMO, fear of materially underperforming, and it's in 7 stocks. It's the Mag 7. And if you're not in the Mag 7 and balanced really heavily, you're in trouble. And you have been, you're underperforming. And frankly, Wall Street, they don't care whether you make money. They only care whether they're performing because it's their job. They hope if they're performing, you're making money, but you're still second on that priority list there.
Right. But the key thing, what I hear you saying start learning how to develop, taking an active approach for the road ahead, because the passive playbook probably is not going to do you very well.
That would be my assessment on the equities right now.
On the equities. Okay, great. All right. Well, look, so let's get into this. All right. So, Gordon, what is the appropriate playbook for the fourth turning? What should we be expecting ahead? And then we can round it up at the end by saying, okay, well, what should we be thinking about from an allocation standpoint? So, should I pull your slides up here?
Yeah, let's do it that way because we can springboard off it from some of these charts specifically. Yeah, the first chart I had was kind of where I wanted to kind of sequence through here. Yeah, these subject areas. I'll maybe come back to that if I can, Adam, this chart here as we go through, because I'm going to start here with the fourth turning, but the other elements on that list of 5 different subjects are really, really key. And I want you to differentiate that because you can build your portfolio from it. But in looking at the fourth turning itself is remembering that it's about economic, financial, political, social change. And so I'm going to take a little sliver of that, of what's important in you building, us all building in our investment strategies. But we need to remember the fourth turning fundamentally is we're in an unstable turn right now. It's unstable, and it's going to to create high risk, a high risk period for investing. That's what's going to come out of this level of uncertainty. It's always been in the market, but it's going to be more so. And I'll talk a little later about what that means in terms of risk premia, and risk premiums on equity. If we go to this next chart, Adam, that actually shows the cycle that we're going on right now. We the how we certainly the work that Strauss and Howe did, which is the whole description of fourth turning. People need to understand that, but there some other people that are superb at cycles. Harry Dent, Martin Armstrong have done a lot of various works, and I built this chart, or we built it to really tying in all types of cycles. And what's so incredible about it is you notice it's this period. It's all come into this period. Now, it's not that finite, but it's maybe a 3 to 4 year window, and we're right in the middle of it right now. And so it does a lot of things people can't make sense of that are going on politically, and some of the chaos is all centered out of this. And I don't want to get historical here, but in 1849 we went through this where we were going from monarchies to republics and democracies, and that turmoil. And after the Second World War, 49, the creation of the Bretton Woods, we restructured the world with the International Monetary Fund, the World Bank, et cetera. We're in the same period right now, and we're only beginning. The changes that are going to happen and accelerate are only beginning. And I think in this year themselves, we're going to see it. We're seeing it with the change, for example, of the new Trump administration. People would say it's bordering on chaos, but it is massive change or at least planned change in ways we haven't seen. But it's not unique to the United States. The changes that are about to happen in Germany, about to happen in France, I can go on, and they're all stemming kind of from the same thing. So this is where we're at right now. And if we go on to the next chart.
And sorry, Gordon, 1 second. I just want to note on this. So you are a sailor. You live not that far from Gloucester, Mass, which is very close to where I was born. We remember, very, very vividly, The Perfect Storm when it hit there, right? This was the book that Sebastian Junger wrote that eventually became the big Hollywood movie. But that's what this chart kind of reminds me of, is we have this red line here, which is these fourth turnings. You have the black line, which is these financial crises cycles. And then we have this overarching 250-year revolutionary cycle. And they're all hitting now, as you were saying. So this is somewhat of a unique moment, right? It's never happened, but it's not that it's never happened before. It happened 250 years ago, but it happens so rarely that what we're seeing right now is kind of unprecedented for anybody who's living still, correct?
That is absolutely correct. And it's not academic. It's not theory, just in pure theory. This is what is happening. And the sooner you come to grips with that, you may be able to begin to see more clearly what the change is signaling, because the crisis is just change trying to happen. And so and and for you to pick the opportunities that'll present themselves, or maybe even more importantly, stay away from the pitfalls that'll come with it, because there'd be a lot of casualties out of these kinds of change. But yeah, there's nothing. This is not a generational cycle we're talking about, which is a 70-year one, and the demographics that we go through. This is much bigger. So governments are going to change, and I'm not. I've done a lot of reading on this. Governments, the formation of how our democratic system is going to come into question. Governments have got too big. They've never been right sized, downsized. We don't even think that way. We just think that they have to be, it has to be that way. We haven't had the leadership or the vision to make the changes that are going to be forced on the leadership. They're going to be dragged out by the scruff of their neck by the people who are frustrated and forced to make big sweeping changes.
Gordon, let me just take another minute on this just to underscore for folks, because I think what you said is really important. We've already begun to see change happen that society, I think, thought, was just not possible or incredibly low probabilities. And I've talked about this, a fair amount over recent months. I think a good example of this was, Biden's withdrawal from the presidential election. A minute before he stepped on that debate stage during his debate with Trump, nobody, especially in the Democratic Party, was thinking that he was going to be replaced as the candidate, right? But then that debate happened, and then massive change happened, and swapping him out with Kamala Harris, and the rest is history. But my point was, is if you would, and a lot of people were, questioning his fitness and all that type of stuff. And the mentality was, no, it's absolutely fine. This guy is totally our candidate. And then all of a sudden, people realized that reality was different than what they thought, and they had to take, immediate action on that. We just had sort of a similar surprise like that in the AI complex with DeepSeek, right? 2 weeks ago. The prevailing, belief was that the big U.S. tech companies had a lock on everything AI. And then China comes along and introduces something that nobody saw coming, right? That we're still trying to figure out what the long-term implications of that are going to be. But it basically changed a sense of what was possible, right? And showing that the AI complex is maybe more under threat than people thought it was. And where I'm going with this is, you said this is not academic, that the change is actually happening right now. And I'm going to use an analogy. It might be a bad fit analogy, but I think it makes the point. For those who were on the Titanic hit the iceberg. For a long time, a lot of the people on that ship just shrugged it off and said, well, yeah, we hit an iceberg, but the ship's unsinkable, and surely the crew is going to fix it, and we're all going to be fine. And they went about with their meals and their partying, right? But the people that really understood what had happened, and that, hey, this ship is actually mortally wounded, they were focused on, okay, how do I get into lifeboats and get people into lifeboats? How do we get off this thing, right? And so what I hear you saying is, hey, you've got to be situationally aware here. You've got to understand that this fourth turning is not just some interesting book that some guy published. It's going on around us right now. And the faster you realize that this change is now the status quo going forward, you got to start thinking about how do I optimize for this new future, as opposed to trying to live by the rules of the old status quo. Is that a decent analogy?
It's a very good one. It absolutely is what's happening. And it's not about just the rate of change. It's the underpinnings of what our belief systems are that we've come to accept that are changing, and the beliefs in how governments should operate. the beliefs in how democracies are really operating. Are they filling the needs of the people? And then we get into the financial systems, whether why are seven stocks right now controlling the entire financial market of not just the United States, but the world? Concentration. We've never had concentration of this level. How could that be? And so when the rules change, what drives markets generally and significantly is the accepted beliefs suddenly come into question, and then people react, and then abrupt changes happen. We say something's breaks, and that's what we're already seeing, and we're seeing it picking up speed. And the more people start to break things, I'm watching some of the Trump's. And I'm not being political here. Because I look at Trump as a blunt force instrument on this change, frankly. Blunt force diplomacy, maybe that's a better word I can call it. But 100 executive orders, 300 some odd executive actions. This is unheard of. We've never seen anything like it, right? Whether you agree with it or not, that's not even the point, whether you agree with it. The fact that this is even happening is profound. Whether he's right or wrong, time will tell. But this is what we better start to expect, because you're going to continuously see things you've never seen before. And you can sit there like a deer in the headlights of a car, or you can say, yeah, that was the signal I was waiting for. And that's what's going to separate the men from the boys.
Okay, great. That is exactly the point I was trying to make. And again, not putting a judgment call on the change itself, but the
No,
fact
no,
that the change is happening, and to deny
recognize
that,
the change. Yeah.
yeah, to deny that is to basically suffer the fate of the dinosaurs, right?
Mm-hmm. Another good example, because that profound change of an era was happening, but nobody really, how quickly we don't know, but it happened, and we're in one of those kinds. It's my personal belief, and I just continuously see the evidence in it all around me. Once
Okay,
you start
so
thinking that way, once you
yeah,
get your mind around that, and maybe that's the best thing people can come away from our session this morning. Adam, is that get your mind around it.
okay, thanks. And that's exactly why I just wanted to pause you here to stress that point, but I think we've now made it. So should I go to the next chart here?
Yeah, the one I've got incumbents being punished, because it kind of leads into what we were talking about. These changes, and I'm going to try to zero it in into America, but it's happening all around the world, as I've said. They're right now they're being punished, and I say the incumbent political class, the political leadership, and we're in a state of policy paralysis. Is two things are happening. For example, have it been about their effective handling of inflation and immigration? We saw that clearly in the United States, but it's not unique to the states. Don't ever think this is about our political system. It's happening everywhere, and it gets into why do we have inflation and why do we have immigration? And there's a reason why we have mass immigration. It isn't just that people are running from conflicts. It's also why are we taking them in such massive ways, and it has to do with the fertility rates now are 1.1, 1.2 for women, and we're not producing enough offspring. If population starts to shrink, we saw in China, if it shrinks, you don't have the productivity growth. You don't have the productivity growth. So economy slow, standards of living fall. So we're bringing in immigration to try and offset that into the job force, but it's not working because it hasn't been done correctly, been totally flawed. And why do we have inflation? And we get into this whole Keynesian philosophy of deficit spending and deficit stimulus, which is wrong and it's flawed and it's run out of time. It's run out of space. So these are two examples of change that's bringing down the established class right now. And for example, and I don't want to get off track, but just to put it in perspective, we always talk about 2% inflation rate, and I want to get it down to 2%. And I always wondered, like, what is the magic of 2%?
Hmm.
And by the way, I don't see it coming down to 2%. I think 3 could be easily 3%, for a long period of time. And the reason we have 2% is very simple, because it hides the debasement of the currency. Because as long as it's 2% or thereabouts, the general increase in productivity and maybe a little slight, 1% price increase in your salary spread out has kept inflation. It's been there, but nobody's paid much attention. But once it gets over 3% or 2.5%, it really shows up. And you got 23, 24% inflation we've had in the last 4 years. It changes the system. And so the question then becomes, what caused it? Like, and it isn't that people just bad policy. What forced these policies to happen? So it's a cumulative pattern. That's what I was trying to point on this chart. So, you talk about inflation and we talk about the immigration and productivity, but, we start to, if you start to skin that thing, this chart really kind of makes it clear. We don't save the money anymore. And if you don't have savings that's put into productive assets, you don't get an increase in the productivity and consequently increasing standards of living. So we've offset it. And this is going back for decades now. Increasingly, you see in the black area where we use credit. And credit is used for consumption, not going into productive assets. And so we've been able to run the economy by massive credit creation, and it's worked effectively, but there are consequences of everything. Consequences that come due eventually. You can't bet on it on a daily basis on the stock market, but it's like an iceberg. It's still there. Your Titanic example. But so what's happened recently, as you see on the right-hand side, is that credit growth hasn't been growing it has to grow at a real rate of 2% per year, or we fall into a recession and various problems. We haven't been growing at a 2%. And so we've been offsetting it by, in the red, the blue, or the green rather, is the Fed, quantitative easing, pumping money into the system. The rest of the world coming into the America by us increasing the size of our debt. So we've been able to keep the credit growth going in a different way, but it's not growing fast enough. And to sustainable. Ever mind now, the size of the debt, we all know about it, but that's like tomorrow's problem. Well, it isn't tomorrow's problem. And that's part of the change that's happening. We go to the next chart to put it into perspective. This chart really is a theoretical one, but it's what's happening. Credit isn't growing. We go through these stages where when you move away from sound money, vis-a-vis you go to a fiat currency system, you go through these stages of speculation, and effectively you end up with almost a giant Ponzi scheme, which is, by the way, what's our whole financial system is on the border, or has become. But the first wage is where credit starts to have a problem, and that's what I'm alluding, and it falls off. And I'm an Austrian kind of guy, Austrian School of Economics. I'm not a Keynesian, which is, by the way, a flawed system in today's system of how you create growth. And von Mises was very clear. There is no means, and to quote him, there is no means of avoiding the financial boom brought on by a credit expansion. It will fail. And that's what we're in right now, because we've been substituting credit for a lack of savings and the size of the growing debt. And it's not involving, as I said, we're getting less for more instead of more for less. And that's a sign that capitalism is now failing in the system, again, because of the abuse of credit, and that gets into the derivatives market. If we go to the next chart, it starts to really bring it right out in our face right now. And that is that you can see the national debt. We all are probably bored with listening to it, but it's outstripping the growth in the GDP. It just isn't keeping up. And so what's happening is there's two core problems here. The United States consumes more than it produces, and we've been doing that for 35 years. But we consume more than we produce, as opposed to producing more than we consume. And so it ends up destabilizing, and it's destabilizing the world, part of it. And the other is what I've been alluding to is U.S. deficit spending is no longer generating the GDP growth that it once did. And we've lived on this Keynesian belief that pumping more money will create more growth. Well, it just doesn't work that way anymore. And people are not listening to that because, as this chart at the bottom is saying, that we were getting I can remember the days when 40 cents would get us a buck of growth by lending, and we were offended by 40 cents. Now it takes $2.50 of new debt to produce a dollar of economic growth. That doesn't work very well. It takes $1.50 of deficit growth. That is your budget deficit growth, which would be $2 trillion. It takes $1.50 of that to get a dollar. That doesn't work. And on a global basis, it's about a buck to a buck right now and growing. And last time I talked, I showed you that. But the recent statistics, and I just did them here the other day, Q4, the GDP numbers that just came out, it's now $5.80 to get a dollar of GDP growth. And on the full year last year, it was $3.90 for a dollar of GDP. In other words, the system doesn't work. And we can talk all we want, but it's not working. And nobody is really appreciating that. We're going back to this massive amounts of change. And unless we adjust for that, no matter what we do, it's just leading us into further problems. I'm not as negative as I'm being here. These are just the hard realities, whether you want to accept it or not. So you go
Right.
on to the next chart. Any
Real
questions?
quickly, yeah, I just want to note on that. So what you're talking about there is classic pushing on a string, right? Which is that
Yes.
it takes more and more effort to try to get the same amount of results, right? And that's what you see in a late stage failure of a system is, you have to keep doing more and more of what you're doing before to try to keep the system going, and eventually you get to the point where no matter what you do, the system is not moving forward anymore because you're just pushing on that string. Um, and the second.
Which is unfortunately exactly where we are without any recognition that that's where we are.
Right. And the other aphorism I want to bring into this is the old Hemingway quote when they asked him, how'd you go broke? And he said, well, gradually and then all at once. Right. And I think that that's the thing to note about why you're saying where we are right now, which is we've been kind of, you showed the chart of the tremendous amount of growth and debt funding of the US economy. That debt funding, you can just look at it as borrowing from the future or maybe even stealing from the future, right? Where we were taking tomorrow's growth and trying to pull it into today. You can only do that so long, right? Before the reckoning point that's out there in the future arrives, right? And everybody's sort of known, yeah, at some point in time, this could create some issues. But recency bias being what it was, people are like, well, we haven't had any problems yet, so we're probably not going to have any problems anytime soon. Well, eventually you get to the point of the timeline where the problems manifest and you can't sidestep them anymore. And that's exactly when you begin to get to that pushing on a string step. And all of a sudden, tomorrow arrives very quickly. That's the all at once part of Hemingway's quote. So again, I'm kind of mashing all this together because I'm trying to underscore what I think you're trying to say, Gordon, which is we've been living this unsustainable lifestyle nationally. A bunch of other countries too have been doing the same thing. And we've been getting away for it with so many decades that we've just kind of assumed that this was going to continue forever. But no, this was unsustainable. And we're now finally hitting the reckoning point where we cannot continue with the status quo.
Precisely. But it's not as finite as it's going to happen tomorrow, or we're going to see a crash in 90 days or anything like that. That sort of thing will eventually happen, but depends how we react to it. But we're going to see the cracks appearing in all different places that as we go along, we have to react to them. The good news, that we go to the next chart on this, when I'm showing credit versus wealth, and and why it may not happen imminently, because we've seen to went from one solution to the other. You just made a very good point, Adam, that we were bringing demand forward. Quantitative easing, which we did for the last decade, was nothing more than bringing future demand forward and pulling it out by putting money into the system. Well, if you keep pulling things forward, where's the big demand today that we need? Well, we don't have the demand. Look at China clearly. So we pulled it all forward. Well, where's the new one? And so you say, well, we need more growth. Well, we're finding out you put more debt into the system. It doesn't, you can't borrow enough money with enough leverage to even make it work. So where's the problem? But the reason it's still working as we kind of migrate to another patch job that works, and this one may work for a while, is this chart shows you credit versus wealth. And this word wealth bothers me because wealth can only be built, mined, grown, or produced. It can't be printed. And so wealth here is really printed money or stock market money, if you want, or wealth that you think you're getting out of financial assets. So the black line says our financial assets, our parent wealth has been growing at such a rate that it's actually allowing us to, I'll use the word create credit. Really, it's leverage in the system, leverage in the derivatives market that have kept this system alive and growing. So we're able to sustain it. Now, when's that going to happen? I don't know. How long steep is that black line going to go up? I'm going to show you some charts of my opinion on that. But what's important here is look at down there, the red circle I put on. That's 2008. And what happened then was credit fell off as we fixed the, and we came out of the problem as we tried something we never tried before called quantitative easing. We got rid of the derivatives mark to magic. We never did change that. So derivatives are still not, that's a whole different discussion, are not priced correctly. But look at how quickly the credit, the wealth fell off. We all know that, but then it recovered and we've taken off. And look at the rate that we've taken off with the wealth. Well, what happens this time if the wealth comes down? What's it do to the credit with this leverage in reverse? So we're in a very high risk a problem right now, or not problem, situation. At least as well, actually right across all spectrums of commodities and dollar, et cetera, because they're all integrated here. But this is really troubling. Now this can go on for a while, and we really kind of need to look at how that might go on. Any comments there, Adam, or is that
No, I mean,
self-explanatory?
just accept to really point out for people in that red circle you've drawn there that you said credit came off, which it did. But look, I mean, it came off barely. And we had that massive market correction that seared into our memory as the great financial crisis, right? I think you're concerned that we could have a bigger decline in credit, and if a tiny little wiggle almost crashes the world, 15 years ago, what does something more substantial than that now do?
That chart's screaming that message. It can't be any clearer. Of
Right.
course, that is clearly exponential, but when do exponentials end when they're vertical? And I'm going to show you some charts where we're actually vertical. That's when exponentials end. If you get back into your basic calculus courses, if you remember, in first and second derivatives. But if we move on, let's get off some negatives. Let's move on to some others right now. And in the next chart, let me just go back to the basic roadmap because I want to switch gears if I could, Adam.
Sure.
Because this is the headwinds I was referring to. This is the problem. This is the thing, the core of what's beginning to create the change and adjustments because this problem has got to be solved. It can't be swept under the carpet. And it's a global problem because of the complete imbalance of trade that we have around the world. Or the biggest country in the world, the United States, consumes more than it produces. In other words, we don't pay our way. So the next chart, I'm just showing I talked about it before. We're at the end of the Great Moderation, and this happened because we had interest rates so high coming out of the 80s or 1980, coming out of the 70s, when Volcker took it up to nearly 19%, that era to stop inflation, to stop the problems we were facing in the 70s. So we've had all these years where interest rates have kept steadily falling and making everything cheaper. And with the whole advent of modern mercantilism, where somebody like Japan or China takes the money they get from us, sends it back to the United States, buys our bonds, which drives yields down, makes the currency up, makes it cheaper to buy their goods, and they get richer and we get more and more indebted. That's modern mercantilism, and it's been working beautifully for everybody else, but the people who actually incur the debt, the United States. Well, but that era of going down to zero interest rates has ended. And so if we go to the next chart, you can see that we knew it was coming. And so with the rates have changed, but everything has shifted. So the era we're going back to is the era we had pre-great moderation, where things are volatile. We get higher inflation, we get higher interest rates, and we get risk premiums that are associated with stocks and bonds. That's an inevitable. If we just revert to the mean, we should be expecting that. So we're moving from an era to an area of higher rates, and there's consequences of that, which means we can expect quantitative easing soon. We can expect yield curve control, kinds of things that Japan did to get itself out of the lost decades, things that China is now being forced to do. They're ahead of us. A weaker dollar that at some point will start to show itself. So if you go to the next chart, what we see is this is how I look at it personally, is the change in bonds with duration premiums that are out further, and in the equities on terms of higher risk premiums or equity risk premiums that have to come in. And that hasn't actually started as well in the equities because of this dramatic concentration, but it's definitely started in the bonds. And as these change happens, but some of the structural moments that are in front of us will be on really major adjustments in these particular charts. And if you go to the next one, with the great moderation, some of this is really, really clear when you go across sectors, commodities, dollars, currencies, and various currencies and various yields. And they all come out with the same kinds of patterns. And one of the things that you do when you do a lot of technical analysis, and I've done a lot of that, is you learn very, very quickly that it isn't necessarily that the charts are right, but the more that the computers themselves are all programmed and they're buying, and especially with so much computer trading going on, they've all adopted algorithms that are based on about 7 different principles of technical analysis: Elliott wave, Gauss, Fibonacci, trend channels, etc., different degrees. And so what happens is, I've often said here, we don't know how it's going to get there, but we know where it's going to end up, because the computers start feeding off each other, and they actually coalesce, and they coalesce at trigger points. And that's a fact. We just see it all the time. And our job, we find around here, is finding those trigger points. And this chart is showing some of these are real clear of the trigger points. And I'll let you take away from this chart is rates are going up. Yields are going higher. That doesn't mean we won't bring in yield curve control, quantitative easing, and drive them down and actually showing a correction. But it won't work, because you're fighting all these problems that we've been talking about, and they're going to go up. And can this society operate in a 6 to 7% kind of yields on major duration in the bond market? And the answer is no, it can't, not with the current leverage that we have in the system. So so it isn't that everything's going to collapse. It's going to force massive changes that our politicians and political class are going to try and attempt to handle, and they will fail. And they'll try again, and they'll fail again, and we'll eventually get an answer to the problem, hopefully. But these are the things that we're currently facing. Switching to another subject that ties together, and I hope you can see how they overlap, is we are in the midst, and have been for a while, the greatest debt for equity swap in the history of this country, or actually the financial world. We are continuously taking debt, increasing debt. Let me put it into words we all understand: stock buybacks, where corporations en masse now are taking their balance sheet, loading it up with debt, using that debt to buy their stocks, which reduces the number of stocks. So the same earnings generate a better earnings per share. Same earnings. So if everything's flat, you're still looking, inflation's there, you're looking even better. So, and then and by the way, stocks go up, you can borrow more money. And so we've got this going on in fairly well, actually in a massive way. The good news on it is it's not quite as bad as that just made that sound, because certain corporations are really growing their earnings at staggering rates. The Mag 7, their earnings actually being delivered and their forecasts are staggering. And so they actually deserve the PEs. This is not like 2008 or the dot-com where these things were totally mispriced. That's not the case this time, which is what's confusing everybody is because they are actually more or less price rate. They're expensive and you're paying up for them. The problem is with them is are these earnings sustainable? And you just saw it when you brought it up, DeepSeek. Rules can be, something can suddenly be changed. And NVIDIA, what's it worth now? How many, $1 trillion worth less? And we're talking hundreds of billions of dollars in market cap like that. And all of these companies that are in the Mag 7 haven't been around more than 10 years. Matter of fact, all of them that were in the 80s or the even 2008, but certainly the dot-com are gone, or they're really not. We don't talk about them. So change is happening, and they're going to happen to their business models. And at these elevated levels, that's a real problem that we have with this whole movement to debt for equity. So what's hidden underneath it, and maybe I'm getting now to the point where we really need to understand the trap that we're into, and therefore we'll get to how we might get out of it. As I showed this chart last time, Adam, this is the one that shows the concentration. Markets fail because they get too concentrated. And you can see on the left, we had, most people don't probably remember the Nifty 50. Unfortunately, I do, where we had really 50 companies that controlled the marketplace. And that ended badly. Well, then we went into the dot-com. It was the same thing. We had, it wasn't the Nifty 50, but it was still a substantial amount from Cisco that just controlled the market. And when something went wrong in that group for whatever sets of reasons, it was the dot-coms were just totally mispriced, where we lost the ability for price discovery, where we lost the ability to do price risk properly, which by the way, we're in now. They collapsed and they went down. Well, right now, our concentration with the Mag 7 is right off the charts. And as bad as this looks, the straight line across, you can see where I showed this chart the last time I was, or not, maybe a couple times ago, over a year ago. And I didn't update it because I said we broke that not long after that. I was gone to like January of last year. And you saw what we did last year. This chart now, if I was to update it, is higher than the Nifty 50. So it says minimally the market's pretty, that's not the market. The situation is pretty risky. As long as these financials are able to deliver their earnings projections, things are fine, and their margins, but there's never been corporations that could sustain those levels of margins without fair competition or being a total monopoly. And that's the problem we're in. And why they're getting away with it, look at the same of this chart here, Adam, is this is buybacks. Doesn't that look like the same chart I just showed you with what's happening in the stock market? So it's being driven by this cycle of buybacks. And if you get inside the buybacks, the question you have to ask yourself, and I'm showing you here this chart, which is the stock market, that exponential and where we are. But look at the bottom there where I've got that black line and the divergence. That's stocks. So it says prices are going up, but the stock volumes are going down. How's that? How can you be stocks all going up, but you're selling, there's actually less volumes of stocks? Well, the answer is nobody trades stocks anymore. You buy ETFs, which by the way, really are derivatives. They don't hold all those stocks. They hold derivatives on them. People are not buying stocks, they're buying options on everything they call, whether they're call premiums or hey, well, now we're down to daily options on stocks. So you can see well, look at the growth in the options market. We got the same kind of chart going up straight up. So and if you look at the single stock ETFs, again the same. I'm showing it in the same growth. And what's underneath that? I'm showing here this float versus pool chart. I did a lot of work on this in 2016, I guess 2018, of what's happening underneath. And this is probably one of the more important charts I'm going to show here this morning, is the difference between the float and the pool. And the pool is the total number of stocks that a company's issued. The float is actually those that you can actually buy. They're available to be bought and sold, and there is a difference. And so let's start with the float here at the top. I did a video on it called the stock float. I did another one on the stock pools explaining all this. It's on our site, so you can go through the 100 slides of all the details in it. But we started changing the rules after we came out of the dot-com problem, before we got to the 2008 problem, where in 2005 we went to a float adjusted pool. And so this is and by the float adjusted stock floats, right, were adjusted. So it's not as opposed to pool, but a float adjusted. So therefore, what you could buy and was available to you had to be adjusted. And it was adjusted by, as it says here in the middle, between restricted stocks and restricted holders. And there are so many categories and types that if you are one of those, your stocks that you hold don't go into the pool. They don't, or rather, don't go into the float, I meant to say. So if they don't go into the float, there's less to buy, the stocks go up. So the more people that are restricted, the less stocks that are available. And the categories of the 11 on one side I'm showing and the 8 on the other, which I identify in the slide, is unbelievable. And so you get people like private equity lending money who take all these stocks out of the float. So we have this whole adjustment process, which is really today got out of control. If you go down to the left, I show stock pools. Now what the pool is here again is the total available stocks. Forget what you can trade with the restricted, but what's available as a pool. And so what's happening now is the pools are going down in total because every time you have a share buyback, they disappear. The stocks are out of the pool completely. Nobody can get them. Isn't that somebody's holding them? They were taken out of distribution. So the buybacks are reducing it, and the number one buyers of stocks are the buybacks. So the total pool is being shrunk, which makes stocks go up in price because there are fewer of them. It also makes the debt worth more money because they've lent the money, but that's another discussion. The other thing is exchanges. The number of listings, stocks are being taken over by private equity, mergers and acquisitions, bankruptcies, etc. So in 96, we had over 8,000 companies. 2016, that was down to 4,300. Today, it's still around 4,300. The difference is they're there's only today 3,600 of them are over $250 million in total market cap. So even the available stocks to buy has got so small that they're being driven right through the roof, and it's going in a circular fashion. And if you look at any questions on that, Adam, before I get into what's going on here?
No questions, Gordon, beyond just underlying the point, as I understand it, is that you're saying that supply is being artificially restricted here, and you do that, demand sends prices higher, but it's all being done for artificial reasons, not reasons that are based on fundamentals.
Exactly. It's being, I won't use the word manipulated because it's the way the system is now working. There's no bad people in it, but there's a lot of people who figured out how it works. And that's why you're getting this concentration. And it reinforces itself. I don't mean to pick on Apollo, but I'm just giving you an example of private equities. And you can see their chart looks exactly, matter of fact, even steeper than all the previous charts that I've shown. And they're not too different as you go through these private equities are trading trillions of dollars in market. They have that kind of power now. So, and I'm being hypothetical here. So if you're a private equity, you lend money to these companies that want buyback, and you get something for lending your money more than interest. You can get warrants. You can take stock options on it. There's different ways you can secure the asset, ever mind what you'll be paid as a premium on it. So when they do that, the companies buy back their stocks, which is making the executives look better. The company makes it more attractive. Stock price goes up. All of a sudden, the private equity guys say, "Look, oh geez, I'm going to exercise my options." They take more of the stocks. They got more capital. They can lend them more money, and here we go, keep going around the rule, around the circle. Well, what this circle leads to at some point is there's no equity left. It's all debt. So who owns the company? The debt holders, the,
Hmm.
the senior security holders. So you have this massive takeover of the markets by this debt for equity swap that's been going on right now. And where does it lead and where does it break? And this is the bigger concern, especially when you get it down to 7 stocks. But it's much broader than that. It's a big chunk of the S&P are in similar kinds of boats right now, as we go through. So these are where the cracks are going to start to show as we move along here over the years. Now, one of the things, the next one I wanted to show you is the stresses it's putting on in the credit cycle. And I want to get this a little bit of the, and I hope I'm not boring everybody, but I want to give you a perspective of the change and where we're at right now. This chart here,
Yeah, this is all fascinating, Gordon. So don't worry about that. We're all
okay,
attentive here.
thank you. This chart here is a yield curve. There's three panels in it, and what it is we're differentiating between the 10-year rate and the Fed funds rate. And I put it together, actually, it's proprietary. I put it together just after the dot-com bubble, because I got the dot-com bubble was a tough time for me during it. After it turned out all right. But what I noticed was that on the left, how things were happening between the yield curve, the relationship of something had developed a proprietary momentum structure down at the very bottom, and we still use it extensively, along with what was happening with the market and when the market started to roll over. And it saved us, absolutely saved us in 2008, because it always takes longer than you think for something to happen. One of the
Mhm.
mistakes I was alluding to in 2000, dot-com bubble, is in the fall of 1999, I liquidated everything we had because I felt the market was going to crash. Well, it didn't crash. It kept on going into the spring of the following year, 6 months later, and I lost a lot of clients. It was a tough time. And then all of a sudden, the market cracked in March. Didn't break down, but it started to crack. It really started to break in September. And that's, by the way, it reminds me of exactly what I am today. I feel exactly the same way right now. It took longer, but that chart would showed me how to avoid it, of the delay that was going to happen, and it's all about the yield curve, and that's what it's the same pattern in 2008. Over on the right is today. Now it's been distorted dramatically with COVID, as you can stand the yellow area that's out. And the bottom line of this is it's not the inversion of the yield curve. It's when the yield curve goes positive, and you can see when it goes above the line on the very far right, and we've been waiting for it to finally go a positive, and it's just banging through it now. And you can see the others all line up in the same kind of pattern, is when you finally start to see the collapse or start to break down. So sometime between now and the spring, and I would say between now and March or April, this is liable to really crack. But don't ever underestimate what the government, the Federal Reserve, will do with yields and rates and et cetera, and change that curve. So you've got to kind of watch it. But it's signaling very strongly that all of this game is about to halt, potentially quite abruptly. And if you go to this chart, which is a long-term S&P chart, you can see these channels, and a long-term channel in red, the short-term channel in black. You can see the upper limits that we're at. You can see the line down through the middle is the Fed funds rate and the drop and how it can come down and where we're anticipating it coming down to. And also down at the bottom where the overall global momentum of all transactions, where it's heading. They're all lining up pretty clearly. It says right now, as things stem, we'll see the beginnings of some level of correction potentially. And we went back and this is speculation here. Please do not trade from any of these. Just understand that in this change, people will react and policies will change. So these charts will change. That's just how it works. But this chart goes back. We put this back in. Oh, when we start to see actually we're back earlier, but when we started to see that exponential growth with the buybacks and that cycle game that was going on with the private equity game, we really put this together. And our projections, and this one was saying that we would end up at 6,400, though we were calling 6,200 for a while, but 6,400 sometime, and I think it's saying in April down here at the bottom. And we've had this chart for years, and it's just simply basic technical analysis and using parabolics and Chen channels on it, and it says we just keep tracking right to it. So there's certainly we're getting near something that's important and we need to pay attention to in the change. And when we did that chart, you'll see this thing we put together in 2012. The point I'm making here is we're on a roadmap that just keeps unfolding in front of us that ties into the fourth turning right now and the dates that are within it. And we put this together when quantitative easing came out in 2012. You can see this done the copy market, a copyright, because we said this is monetary malpractice that we're doing with fiat currencies. It can only end badly. And everybody says, yeah, right. We can still make a lot of money. You're right. But we were going to go through these changes at the top from misinformation to malinvestment, from moral hazard through dysfunctional markets, from deception through delusions. And we're at that top end right now. And that's what we're starting to see unfold. And we're pretty close to something here. And now that's all the bad news. The good news is that right now the changes that are happening in the country, for example, we did a lot of work on some of the Trump policies, and I'm not trying to, I don't know whether Trump will be successful, and it's not a political discussion. It is our conclusion that the only way out of the quagmire is the United States has to begin producing more than it consumes, has to do that. And all this noise about tariffs, which are coming, and their blunt force object is to get people to the table, which I saw 7 countries change their mind here in the last 10 days as soon as you threatened them with tariffs. Is really, it's about bringing the jobs back to America. I said earlier, without the inflation and the migration issues are got to be solved. Inflation will be solved if people are working and productivity is going up. Migration will be solved if the jobs come home. We lost 54,000 manufacturing facilities in 2002 when China got into the World Trade Organization. We're never going to get 54,000 companies back or manufacture. But if we could get 2,000 or 3,000 coming back to avoid tariffs, to come into the country and get tax reductions, tax relief to produce, even if it's final assembly here, we can create jobs in a bigger fashion than we've had, and we're going to need them, especially with artificial intelligence reinventing the whole service sector. So the bottom line here is, without getting into all of Trump's policies, what they're trying to do is they're throwing a Hail Mary. If they can pull it off, it'll be genius. The chances of it are pretty, it's major obstacle. But it's the only way the United States is going to finally start producing more than we consume and starting to at least fix the debt problem. This isn't going to fix the debt problem I'm showing you with onshoring strategy, but it's going to begin. There's other things that we're going to do. For example, we just announced a sovereign wealth fund. That's going to be another way, especially if some of reserves are held in things like Bitcoin and other very unusual ways of finance that can be restructured to revitalize. Let me show you this. what we call unshackling America. And we wrote a thesis paper on it this year, about 100 pages, laying out all the details of what needs to be done and how it can be done that we use. And you can get it at our website. We're using as a checklist to see whether this administration is doing any of that, can do it, or where it's failing, and it will fail in in many ways. It will be stopped, but maybe we can get some better investment decisions out of it. I was moving along pretty quickly there, Adam, but I just wanted to make sure we got through the slides. Questions?
Oh my goodness. Well, look, first off, fantastic job, uh, Gordon. It's like a master's thesis class. Thank you. Um, and I love the fact that you're ending on, an optimistic note here, which, by no means are you saying, hey, we're not going to have to take our harsh medicine, but that it's not all doom and gloom, that there's a better future here to step into. And of course, that's the whole part of a fourth turning, right? Is the
Yes.
fourth turning dismantles the old sclerotic status quo and builds something that, is better for the future, right? And so we're just living through that transition right now. And yeah, it's probably going to get rough for a while, but again, something better should come out of all this. So
Potentially. And I think it's the first time in a lot of years that I can say potentially we really do have a possibility, a possibility.
all right. Well, I'm glad to see the increased optimism on your end. Hopefully others feel that too. So I
Well, I live
guess
in Massachusetts and it isn't felt up here.
yeah. Yeah, well, I mean, then I mean, part of the fourth turning is, as you said, beliefs. We have to let go of what worked. We have to change our belief system. Right now, we have a country where basically half of it voted for the other person, right? And
Yeah.
so they're probably not in a state yet to get on board this train, right?
Yeah.
And as you
Well,
said,
and maybe a lot of finances are not important or economics not important. My discussion here is solely economics and finance. It
right.
has nothing to do with a lot of social things that are happening that even I'm alarmed about.
Right, right. And as you said too, time's going to tell. These are, a lot of what's going on right now are kind of blunt force uh, tactics. There's no guarantee they're going to work, but again, it's the change you were talking about. Like it or not, the change is unfolding. So you kind of gave a bit of a nod to this earlier, but the folks that are watching this channel, Gordon, not only are smarter for having just watched what you walked us through, but they're regular investors who are they're looking to build their wealth, but I think much more importantly, they're looking to not become collateral damage during the remaining turmoil of a fourth turning. So obviously, your charts there about the market seem to suggest that we seem to be on the precipice of a market shift, right? We've had, many years of easy times in the markets. As you walked us through, it sounds like we could be having another sort of 2008 2000 style correction in the market. Maybe not as severe. Who knows? We don't know yet. But you're seeing that same type of reversal potentially starting now. So as you look to the rest of 2025, you mentioned earlier, you're not necessarily calling for a crash, and you think there's going to be a lot more volatility, but you see opportunity in that. How are you looking at navigating this from an investing standpoint?
Well, being older, and you can see by the color of my hair, I more focus on protecting assets and necessarily dramatically increasing assets. So preservation of capital is where I'm focused on. I am no longer basically in the equity markets, which tells me that I believe this market is too unpredictable and isn't worth the risk. It doesn't mean that there may not be some serious money made this year. I'm not going to be part of that. I just think the risk reward is not worth it. Um, because I can't predict close enough, even though I can't predict it any closer, and I can track it and move around. But what I have found is what I do believe is some of the other markets. We're primarily focused on the bond market right now because it pays very good interest rates on it. It can be well protected. And if in fact the government is forced to take down rates as I did not say it's a solution, but a reactive process, remembering as you well know, Adam, the banks in this country have nearly $700 billion in unrealized capital losses because they have bonds down that they bought at less than 1% or 0%, and they're underwater. This country cannot let the entire U.S. banking system fail. It's got to come to it's got to solve it in some fashion, and that includes the entire U.S. commercial real estate market. So I believe they're going to be forced to do something sooner to saving these banks, and that means attempting to pull down the rates at the same rate as trying to finance a debt that will continue to increase. The whole debt caps will be a huge argument this year, massive in the next 4 to 6 months. But they will have to bring those rates down, and that means capital gains. So it isn't just that you're getting 5%. There could be some serious capital gains that may outstrip anything else without taking the risk. There's that potential. If not, you've just made some pretty good interest. So we're looking at that, though we're still very much in the mid part of the curve, from anywhere from 18 months out to 4 years. So if they do move up, we can roll and take on even higher kinds of gains. And that includes the corporate bond market too, by the way, because the whole zombie, maybe 20% of the of the corporate America are zombies right now, where the interest can't even match the debt that they're incurring that we were just talking about. They've got to be assisted, and we did that in 2008 to stop the zombies from going under, and the unemployment that happens with it. We think, I guess what I'm trying to tell you, we believe the Fed is trapped. There's no way out of this, and so
Okay.
we look at the low risk apples on the tree right now, and we're not taking the risk. So I hope that answers your question.
Okay, well, so obviously the lowest risk way to play the bond market is just to sit in T-bills and get paid for something on a rolling basis. But it sounds like you're moving out in the duration curve more than that to capture the capital gain appreciation as well, if and when the
We
Fed has to step in to rescue.
exactly. But we've only went out longer when we can get north of 4.8% currently. Just to put some numbers out on the longer, anything over 10 years and up. But as soon as it's below that, and it's down now, it's down running in 4.46, I think, as we talk. I wouldn't touch it. So, but we have a lot in the middle, just in the shorter duration. The prudent way is to be in the shorter duration, not even play the capital gains. But we're trying to balance some real good capital gains with the interest rates. But the bottom line for us is we're not playing the equity market with equity games. We're waiting for the dollar itself to adjust, as I said right at the beginning, because the dollar's been so strong. And when it starts to move and starts to fall, commodities are going to be. Now we can enter the equity market, but in certain elements, for example, like commodities. I'm not trying to give anybody an investment strategy.
No, I
Please,
know
I
you're,
do
yeah,
not do that. I am just trying to, you asked me what we're doing, and that could change next week. So,
right.
but I'm
No, very
telling
good
you today may not
underscore.
be.
Right, and that's why I have the financial advisors on this channel for folks to talk to for free.
Apps, absolutely. A,
Sorry,
there's
didn't
never
realize
been
it
a
was
better
roasting.
time that you need a financial analyst giving you professional advice. This is when they earn their money, and you need to.
Well, thank you. The financial advisors that Thoughtful Money endorses are going to send you a gift basket in the mail for that endorsement of their services. But no, may I agree with you? And again, just to underscore, you're being very generous in sharing how you are playing this. That is not personal financial advice. If you want
No,
personal
it's not.
financial advice, go talk to a professional financial advisor. All right, let me just ask you one last thing about bonds, and then a question about commodities. So, uh, if I heard you right, right now, and again, this could change at any point in time, but
Yes.
you're not interested in, you're staying in the mid part of the duration curve right now on your positions for the reasons you explained to us. If yields were to go above 4.8, you might get more interested in moving further out on the curve again. But since they've come down, you're gonna play your strategy as you mentioned it. I'm just curious if somebody were interested in in getting some exposure to bonds and wanting to play it safe, but also having some exposure to a situation where the Fed really has to come in and rescue the market. Yields go down a lot. You get a lot of price appreciation. What do you think about sitting at the shorter end of the duration curve with most of your bond allocation, and then maybe having like a zero coupon bond or exposure to zero coupon bonds? Sort of like a barbell strategy where you've got a lot
Hmm.
parked in safety, getting that nice 4%, whatever yield it is for the time being. But you've got a little sliver there that's in a zero coupon bond that could really appreciate a lot if yields were to come down because of a central planner rescue.
In many ways, that's what I've been talking about here, but a little, not quite that, but why we are also taking some on the higher duration just as a little bit to capture a little bit of that potential. If the yields come, if they're for when the Fed is forced to come down, the Fed will be forced, as I said, to do something dramatic. But we may be surprised at the direction they take.
Right.
They may there's other options they could pull out of a hat that are quite dramatically
Okay.
different. Because
So
remember
so
where we started this discussion, we're in the fourth turning. Things that we're used to seeing, we saw with quantitative easing. When it came out, everybody was like, "What? What are you talking? What is this thing? Just debasement of." Now we just accept it as gospel. Well, there's new ways, new things that are going to come out to help finance and change the rules. For example, I mentioned this sovereign wealth fund. We may find out that the Federal Reserve, how we're funding ourselves is different. And it may not be just about the Federal Reserve. We saw with Bidenomics, they were stealth market. They were funding the government through short-term notes in out of the Treasury market. So there's all sorts of ways other ways that they may want to do it. That's your risk and that's your gamble. I hope that
okay.
helps.
Yep. Yeah, which is don't think you and again that's a good point. Like don't think what the QE playbook is going to be. Like, oh, we've seen this movie before, they're going to do the same thing. They might do something totally different, right? You always got to be careful that
I,
the central planners will always change the rules.
I would almost bet on that.
Okay. Let me just ask you one last thing about this, and then we'll get to commodities. You mentioned that the banks have, 700 billion in unrealized losses, and at the end of the day, the Fed exists to support the banking system more than any other of its mandates that it talks about publicly. Um, we are coming up on the anniversary of the end of the uh, bank term funding program. And presumably, as I understand it, and it might be an incorrect understanding, that the banks are going to have to take all those assets back that they lent out to the BFTP. Is that what's going to happen in a couple of months unless they come up with some other solution? And if so, does that instantly put a lot of additional pressure on the banks, or is it not that big of a deal?
I don't know. I really don't know. I don't know the answer to that. And the reason I don't know it is how they've really been using the money because the banks they got about 60 billion extra dollars out of the BTFP they, by being able to arbitrage it, and they let all that money went into the. And I'm getting a little technical here, but it all went to the highly leveraged funds who borrowed the money from the bank, so that close to 80 billion dollars flowed right into short-term treasuries. So it was part of the stealth game that Yellen was doing and Biden and funding Biden's as we got into the election. So it's how quickly they can pull that money out of the market, and what Bissett really wants to do. He's fully cognizant of what's going on, and you can see that just yesterday with his quarterly funding of what he's trying to shift it with right now. So the primary job of the Fed, forget its dual mandate. Its primary job is to fund the U.S. government. And so the question is at what rate and inflation fighting it. It's not about fighting inflation, it's funding the government, but knowing what inflation could be with tariffs, et cetera, is almost unknowable to them at this point in time. So I believe they're really in a wait and see before they're pushed into a policy decision. I kind of wandering a little on that question. I just don't. That's why I say I just don't know what they're going to do today. But I think I'll be clear. I have to become clear in my thinking in the next 90 days.
Okay. All right. And then getting back to commodities here. So uh, you've mentioned a couple of times you think they're probably going to do pretty well, particularly when we get to a point where the dollar starts weakening. We're talking here in February where gold has made a new all-time high. Um, are you looking to, do you think the opportunity is in the commodities themselves, like gold and hitting its all-time high now? Or do you see the opportunity as more in the equities of the companies that produce them? You mentioned earlier that that may be when you see some real opportunity in the equity market that you might want to start playing in.
Yeah, it's a great good because gold is really really telling on that, right? Right now, the money is to be made in the physical gold itself. It isn't in any of the stocks, whereas the leverage is really in the big producers, and they've been, that's almost been dead money, and certainly then you get into the highly leveraged, and so they haven't been performing, and that's because gold is being bought by the central banks, right? The BRICS have been the big buyers of gold. It actually hasn't been the retail crowd. Retail crowd has been buying ETFs, not physical segregated gold. So, the answer there is you go to physical. But when and your bigger question was, what about zinc and copper and all that and foods? And so to me, the commodities right now are differentiating where the problems are going to be. And they're going to be in foodstuffs because food prices are continuing to go up. If you look at the UN's food surveys, there's no question that the scarcities are going to be the name of the game in the next couple of years, in my mind, because of population is still growing, not the rate I talked about earlier, but is still growing. So scarcities in the food stuff says you can play it at a number of places, but we got a whole different attitude towards health and safety that's coming in right now. And I say that with Robert Kennedy is believing in making America healthy again. And the food producers and distributors are going to be under a lot of various pressures. So you have to sort through that problem, and you need a financial advisor who understands that to differentiate between how much you want to be in food stuff. Energy is going to be a huge issue. Continuous. We have I know it's drill baby drill with Trump, but it takes time. Canada's, going to react in certain ways, but I really do believe we're moving to nuclear in a with small modular nuclears reactors, not the old 1950 style
Mm.
technologies. So some of the uranium players are looking particularly strong right now, or they have been, though they're consolidating. So there you might want to be with the producers versus because you can't buy the product, you have to buy the producer. So there's no fixed answer to that. But you need to tear apart, in my mind, the commodity sector right now, because at the end of the day, we're still a fiat currency. And fiat is not money. You're not growing. I says you got to grow it, you got to build it, or you got to mine it. The real wealth is in these elements. And as I talked about in the previous video, all of our money is so leveraged up right now on collateral transformations, because you only get debt if you've got collateral to secure it, and that collateral is truly questionable. And as we have any problems going forward, it's only going to people are going to move closer to the physical. It's almost inevitable. I don't know when though.
All right, Gordon. Well, look, I could go on for a couple more hours with you, but we went way over our initial time, and I thank you for going long. So I'm going to have to wrap it up here. For folks that have really enjoyed this discussion and would like to follow you and your work between now and your next appearance on this channel, where should they go?
Oh, join us at all my work. We're investors. But I distribute my work through matasi.com, MATASII.com. We have free newsletters, free charts, various things that we distribute. Some are charts are chargeable, if in fact they're in real time and that sort of thing. But come to the site, see if there's some things that are valuable. But I do suggest you look at this year's thesis paper that I talked about, Unshackling America, as a guidepost for you just to kind of assess your portfolio and what to look for. You might find it valuable.
All right, fantastic. And Gordon, when I edit this, I will put up the URL to Matasi there on the screen. Folks will also have a link down in the description for it as well, so you can get there with one click. Please, folks, let Gordon know how much you appreciate him being so generous with his insights here by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. As Gordon mentioned earlier, this is a time that unless you've got a very good track record as a DIY investor in the type of environment that we're heading into, highly recommend that you manage your portfolio with the help of a good professional financial advisor. If you would like some help from one that understands the macro issues that Gordon's talking about, feel free to schedule a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service that they offer. Also, while you're there at thoughtfulmoney.com, go to thoughtfulmoney.com/conference and sign up for our upcoming spring online conference. That's on Saturday, March 15th. The faculty, as you've been hearing me mention on this channel, is by far the best we've yet ever had. We just added Danielle DiMartino Booth and former Fed official Thomas Hunning to it. We've also just added Lynn Alden. So the faculty is getting bigger and better by the day right now. And a reminder too for folks that if you can't watch live on Saturday the 15th, don't worry. Everybody that signs up for the conference is going to get a replay video of the entire event, all the presentations, all the Q&A. So you'll be able to watch that at your leisure. And lastly, if you are a premium subscriber to our Substack, you get an additional $50 off the ticket price of the conference. To do that, just go check the email that I've sent you that's got that promo code in it. And as a reminder for folks, the early bird lowest price that we've been offering for the conference is still in effect. So go lock in your conference ticket now. Gordon, thanks so much for everything today. Really appreciate it. I want to give you the last word here. Just for the folks, like I said, who are trying to navigate all this and hopefully not become steamrolled by it all. Any bits of parting bit of advice for them?
Yeah, I want to echo what you just said. With all the turmoil and all the confusion, and frankly, just the things I went through, the confusion that even I have spending a lot of time at that, I don't think I've ever seen a better time where you really need to get other eyes and ears helping you. You can't do it by yourself anymore. You need a professional, and you need numbers of professionals. They're worth the money in this new era that we're getting in. And the sooner you adopt that process, as soon as you accept that's where you can do, and you just can't day trade it yourself, I think in the longer term, you're going to be better off.
Couldn't have said it any better. Thank you so much, Gordon. It's been such a pleasure. Really look forward to having you back on the program again soon.
Talk to you.
All right, and everybody else, thanks so much for watching.